All right, guys, so it's on everybody's mind these days. What is going on with the U.S. housing market right now? In some places of the country, homeowners and renters alike are really enjoying easier living with manageable costs. However, in other places of the United States, many longtime residents are being forced out of their locales, and this is due to ever increasing home prices. So what's really going on here within the U.S. housing market as a whole? How can you make heads or tails of it all? We're going to be getting into this topic today, as well as discussing where mortgage rates are likely going to be going in 2019 and beyond, so stick around. Hey guys, welcome back to the VIP Financial Ed channel. Really appreciate you, our YouTube family. Here on our channel, we've already passed 142,000 subscribers, well on our way to 150,000. My name is Matthew, I'm your cash flow coach. And in today's episode, I want to be talking about the U.S. housing market and the mortgage rates for 2019. So let's go ahead and dive straight in. When you look at the current headlines, guys, where it's describing the U.S. housing market, you're going to see a lot of descriptors like slow and bottoming out. And really, these are words that might actually convince you to think that we're in the midst of an ongoing depression within the housing market and that it's a much better time to not buy a house than to actually run out, get a home loan at the current mortgage rate and begin investing full throttle into real estate. But I want to bring your attention to what some economic experts are saying about this, because from where I'm sitting right now is seemingly a really good time to start strategizing about how to get your hands on high-powered debt weapons that might just have their foundations in U.S. real estate. Amanda Fung, who's a financial analyst at Yahoo Finance, she explained her current take on where the housing market is going by pointing out that 2019 looks like it's going to be a continuation of what we saw through the second half of 2018. And that was a period marked by moderate to slowing new home sales and a slowdown in the home price growth. And Fung goes on to suggest that while we probably aren't going to see a shift completely towards buyers' favor, conditions are really going to likely improve, particularly in the second half of the year. So we're probably not going to be seeing double-digit home price growth, but if healthy job numbers and wage growth continues to improve like they have been, that could actually bring with it a whole spike in home buying activity. Now, some experts are really suggesting now that what we're seeing resembles the first signs of a full-blown rebound within the U.S. housing market. Neil Dutta, who heads the economics at the Renaissance Macro Research, which is also known as RenMac, he thinks that this is the case, and he actually points to a recent slide in mortgage rates as part of what's causing this. In the second week of January of the new year, 2019, applicants for home loans jumped 13.5% from the week prior to that, an uptick that really brought this statistic to its highest level since February of 2018. This information actually comes from the Mortgage Bankers Association. It's a collective of commercial lenders, and they're the integral part of the functionality of the U.S. housing market. And the MBA's appraisal here, it really seems to be in alignment with what Freddie Mac is reporting about current mortgage rates as well. I mean, a 30-year fixed rate home loan is hovering right now at about 4.45%. And whenever mortgage rates go down, demand for homes goes up in a near lockstep, actually. And as prospective home buyers are able to get more home for their home loan dollar, so to speak, which is going to bring us to the subject of what you should be expecting for mortgage rates in 2019. For some color on this, I wanted to mention what Bankrate's chief financial analyst, Greg McBride, recently had to say about it, because according to him, now actually looks like a pretty good time to lock in a mortgage rate. In a recent quote, Greg actually said, "We're seeing the lowest rates that we've seen since last summer. But as the focus comes back to an economy that's performing well and then the Fed starts to hike rates again, we're going to see mortgage rates go back up." Now, there's a host of factors that contribute to the Fed's decision to modify interest rates, obviously. When economic times are good, it's generally the case that the Feds are going to slowly but methodically raise rates. And when the U.S. economy dips and slows down, rates obviously drop in an effort to spark economic activity again. And it's all a very precarious balancing act, if you will. And the average consumer here in this country is going to be left to their best guesses as to really when the right time is to pull the trigger. In fact, just one short month ago, I insisted on locking in my interest rate. We were expecting one more rate hike, which did occur. Then all of a sudden the rates dipped again. And here I am at a 4.875% locked 30-year interest rate on what's considered primary residence that will over time become an investment property. We've talked about it here on the channel a number of times, but I probably could have done better by waiting. So I missed by playing the guessing game. And that's not uncommon. It really is going to boil down to your best guess as to when the right time to pull the trigger is going to be on a home purchase. I don't personally care. And here's the reason why. As you've heard me mention on this channel, if you're a longtime subscriber, interest rates are simply interesting. If I pay that property in full to zero by the end of the year, obviously whether I got a 4.875 or 4.45% interest rate will make very little difference at all. Interest rates make a big difference over long periods of time. Interest rates make a much smaller difference over short periods of time. And here's the key takeaway that I really want you guys to keep in mind regarding this subject as a whole, especially mortgage interest rates. They shouldn't be used as your prime motivator for obtaining debt weapons in the form of income producing real estate asset. Debt weapons come in many different forms. We consider a debt weapon any tool or resource that allows you to grow your cash flow. There are two sides of the balance sheet: income producing assets and liabilities. Liabilities suck money away from you. Income producing assets bring money to you. And what's left over is your cash flow. So if we can minimize liabilities while maximizing assets, we can stack our cash flow. And your individual decision to get into or out of real estate should really be made based on the strategic evaluation of your personal and business financial position. Something that we actually help people with all the time through one-on-one coaching sessions. Lastly, what I'm going to suggest is that as we move through 2019, you stay on close lookout for signs that what's going on within the US economy and the US housing market could be closer to a resurgence than a continued decline. I believe that the pendulum could very well swing into the home buyer's favor this year. And you could be one of those that profit handsomely from it. Make sure you check out our video that we're dropping regarding my current purchase, which will show you that I can retire on just one investment property in what's considered to be one of the worst times to buy a home. So make sure that you keep an open mind because good opportunities can show up in any market. As a quick added bonus to today's video, and since we're on the topic of housing and mortgages, let's go ahead and chat real quickly about the FHA loan limit increase. At the start of 2019, HUD, the Housing and Urban Development, made a change to the FHA's loan limit ceiling. It increased it from $294,515 all the way up to $314,827. And this is a great piece of news for potential home buyers because they can actually benefit from more qualifying flexibility and higher priced homes while securing an FHA loan, which is a really cool product for the right candidates. Just a reminder, FHA loans, which is part of the Federal Housing Administration, they allow buyers to actually buy a home with a very little down payment, as little as 3.5%. So the loan limit ceiling increase is a fantastic addition for home buyers that are looking to get in to a home with as little down as possible. So that's it for today, folks. If you found this video helpful, please make sure you drop a like on the video. We need those thumbs up to continue to grow. We want to hit 150,000 subscribers as soon as possible. And it's thanks to viewers like you that we're even here in the first place. So we really appreciate your viewership. Make sure you're a subscriber to the channel as well so that you are a part of this community. Again, we're trying to raise awareness that there are much better ways to manage your banking and borrowing than what you were taught or not taught, for that matter, in school growing up. So make sure you stay tuned, hit that post notification, and be sure to claim your one free coaching session we offer to every viewer here on the channel who has at least $500 per month left over in working cash flow. If you have that, we can be of tremendous value to you and we don't charge you anything for it. So claim your one free coaching session. We do have quick start vacancies that are available for people that just don't want to wait a lot of months for that free coaching session. It'll jump you to the front of the line. You can become a paid coaching member and we'll start fast tracking your results. Guys, we look forward to working with you. Until then, make it a great day. Enjoy all of our videos and take care.